Hi, I'm Bruce Davidson with Mosaic Real Estate Investors. I'm Managing Director and Head of Asset Management. And I'm sitting here with Dan Lesser, who's the President of LW Hospitality Advisors. And Dan's one of the top hotel consultants in the industry. Dan, thank you for spending some time with me today to talk about the wonderful hotel industry.
Thank you for the invite.
My
It's
pleasure.
Great to be here.
One of the first questions maybe we can spend some time discussing is hotels compared to other real estate asset classes, i.e. office, retail, industrial. What's the differences between a hotel and everything else?
Hotels, as you know, it's a special asset class.
Sure.
It's a unique asset class. And your question is very apropos in that hotels are very unique forms of commercial real estate. They're unlike any other forms of real estate. There's no credit tenancies. You're leasing guest rooms every single night. The pricing of guest rooms, with technology being what it is today, it literally changes by the nanosecond. In an up market, that's a beautiful thing. In a down market, it can kill you. The repricing aspect. Very labor-intensive business married up with bricks and mortar real estate. And if you think about it, full-service hotels, resort hotels, they generate revenues not only from putting heads in beds, rooms revenue, but they generate revenues from food, beverage, recreational, a wide variety of revenue streams that frankly are very different than putting heads in beds.
Sure.
And then all the expenses associated with those different revenue streams. It's a complicated business. Hotels also tend to be structured with many parties involved in a transaction, whereby they don't all necessarily have their interests aligned. So if you think about it, there's the equity, the debt, many times a brand, an operator, an asset manager. Mm-hmm. There are all these different parties, again, where it's very easy for it to be structured whereby the interests are not necessarily aligned. So yeah, those are some of the key differences.
So we've worked together. We've been friends for a long time. We've worked on a lot of interesting deals together. And you mentioned a couple things that come up with different parties involved. You have a hotel. Let's talk about maybe the differences between so for a luxury hotel versus a select service hotel, and differences by having a hotel company as a manager versus a third party operator and a franchise. Maybe we can talk a little bit about that.
Sure. Well, obviously those are two, although they're within the same product type, being lodging, they're very, very different animals. Select service has definitely been a very attractive investment opportunity for the sector, because if you think about it, the income streams that I spoke about a minute ago, the most profitable income stream out of all those is putting heads in beds,
Sure.
Rooms. Luxury hotels that maybe have a residential component, that are spread over large properties in terms of acreage. I mean, that's a completely different animal. The segments that it's catering to tend to be leisure and group oriented, as opposed to select service tends to be more corporate, transient, overnight type business. So very different animals, very different risk profile. The size of those deals tend to be very different as well. Select serve tend to be total capitalization, Sure. Much smaller than full service and resort properties.
Sure. When you're advising clients, what are some of the big risks that you see in underwriting a hotel investment opportunity? And maybe the more difficult one is maybe we focus more on the full service and luxury sector because there are more moving parts than a select serve hotel.
Sure. Well, I mean, at the end of the day, location, and that really is something that's fundamental. That even with the advent of GPS, is still an important factor, and I think it's very important vis-a-vis full service and resort properties, probably even more so than select service properties. Mm-hmm. The risks, location, timing of of acquisition, investment, development, whatever it may be, the hotel markets tend to be very volatile. If you think about it, on September 10th, the world looked very different than on September 12th. And if you go back to what I spoke about earlier, vis-a-vis daily leasing of guest rooms and constant repricing of guest units, September 10th, September 12th, the world looked very, very different. Right. And I actually recall working on a proposed hotel development, luxury 5-star development in Manhattan that ended up opening up very shortly before 9/11. Amazing, beautiful asset. At the end of the day, the basis in the deal on a per pound basis was extremely high compared to what it was worth on the day it opened up. There may have been a little bit of ego involved in that as well. It's always hard to put a value on an ego aspect of a hotel investment.
Sure.
And it is kind of interesting. Unlike office buildings and shopping centers and residential buildings, ego does become a factor with hotels much easier than those other asset classes.
Right.
Other risks are obviously clearly management and identity of a property, whether it's branded, soft branded, or purely independent.
So on that note, and I don't mean to interrupt you, but for people
But you just did, so don't worry about it.
All right. For people who don't really understand the hotel business like the two of us, the differences between kind of branded, soft branded, independent, maybe before you get into, because I do want to talk about the risks and more of the detail that you're going to get into in a second, but maybe just explain to the people who are going to watch this on what those terms actually mean.
Right. Well, there's been a little bit of blurring of those terms as time has gone on, but theoretically, a branded hotel, so think Marriott, Hilton, Hyatt, right? Those are distinguished, well-known, established brands. At this point, each one of those entities have evolved into families of brands, right? So Marriott's got 30 brands within their sphere. Hilton has, I forget what they're up to, 20, 25. Hyatt has a whole series of brands underneath the Hyatt moniker, if you will. So those are branded properties. Soft brands are typically housed and domiciled within each one of those brand families. For example, Hyatt, the Unbound collection is considered their soft brand. Marriott Autograph is considered the soft brand. So what it allows is it allows developers and investors and owners to maintain certain standards, but the standards are not strict standards for each element of the hotel, and allows for unique development opportunities which embrace the surrounding area where an asset is located. Again, maintains a certain quality, but has its own distinguished characteristics. And yet takes advantage of the reservation system.
That's what I was going to say.
Of the Marriotts and the Hiltons and the Hyatts of the world. And there are many lenders out there who, unless it is affiliated with a major reservation system, will not be interested in providing debt financing.
Because you're getting the ability to tap into a huge distribution system.
Correct. Now, I do want to finish the answer though.
Sure. Yeah, please.
Pure independent hotels, what we've seen a lot of is somebody develops an asset, comes up with a unique name that identifies the asset, and then all of a sudden that name now becomes a brand. And we've seen where then, in other locations, additional properties get developed using the same moniker. So independents end up evolving many times, becoming brands in and of themselves.
Right. And part of that too is also tapping into distribution systems that the independent operators can do.
Absolutely.
Right?
Absolutely.
And, look, as you know, I also worked for somebody in one of my past lives who had an independent brand that at one point in time was growing in select destinations around not only the U.S. but they were looking around the world. And that's right. It becomes a name, forget about putting aside a Marriott or Hilton for a second, but as the independents, and I'm sure you will agree, once that name catches on and there's a cachet about the property, whether it's the club or the restaurant or just the room or the service, there's a lot of ability for them to continue to drive business that way just based on the name.
Absolutely.
Right. So maybe let's go back to the question I interrupted you about the risk when it comes to underwriting. You had started talking about having strong, not only management at the property, but maybe focus on not only the management of the overall property, but kind of the revenue management, because in my view, revenue management is key since you are resetting rates daily, and how does that factor into the overall market?
That's a great question. And actually that also ties back to the first question about the unique aspects of hotels. So if you think about it, hotels are offering a perishable commodity, room nights. An empty room for one night is gone forever. It can never be resold. Very similar to airline seats, right? A plane takes off with an empty seat. You can never generate revenue out of it. It's a perishable commodity. And so the name of the game for products and offerings like that is yield management.
Yep.
Right?
Yep.
Maximizing the yield of whatever inventory you're dealing with.
Right.
And so a hotel running at 100% occupancy is not necessarily a successful hotel, because maybe it's sacrificing room rate in order to achieve that. And a hotel operating at $1,000 a night in average rate with 10% occupancy is also not necessarily a successful hotel. It's a combination of the two, and revenue management is the moniker that frankly was adopted by the airline industry and then taken on by the hotel industry to maximize the revenue yield of an inventory that you
and if you have somebody who can manage the revenue side of the business on the rate and be able to manage the operating expenses in a very efficient, you could have a very well and performing and profitable hotel, in your opinion.
Absolutely, right? Absolutely. But again, timing is very, very important when an investment originates, and the exit strategy. Frankly, when you go into an investment, there should be a defined exit strategy. Whether that actual exit strategy comes to fruition or not is a different story. It brings up an interesting topic in that hotels are fundamentally long-term investments. And what we've seen over the past 10, 20 years is many investors underwriting offerings with 3 to 5 year holding periods. And that can be a very dicey proposition in the lodging space. Folks that did that in 2010, 2011, at the time, kind of scratch your head, what are these guys doing? Many of these folks hit it out of the park. Right. If you underwrite today with a 3 to 5 year holding period, again, I think that's a very risky proposition. Hotels should be underwritten at a minimum of 7 to 10 year holding period, which again does not mean that you're necessarily going to hold on to the asset for that long, because if an opportunity, a capital event opportunity happens in year 2, 3, 4, what have you, and it makes sense, you'll take full advantage of it, but you need to be prepared to hold on to it for a minimum of 7 to 10 years.
I agree with that. I totally agree with that. Well, look, we've been talking for a bit. I have 2 more questions. One will probably be an easier question, and then the other one I want to just kind of touch upon. We've talked about some really good things, but I also want to maybe have a little bit of a case study discussion. But though the easier question, at least in my mind, is as the industry has evolved on distribution, right? With Hilton, Marriott, we talked about distribution through them, but with the OTAs, Airbnb, which has always been a topic in the last couple of years, where do you see that part of the industry evolving as far as how rooms are sold?
Great question again. So let's take it one at a time. Airbnb. Airbnb is very interesting. It's interesting in that the concept of Airbnb, if you think about it, is really nothing new. VRBO, HomeAway, the notion of people renting out their homes or parts of their homes is not anything new. Airbnb was very successful at democratizing the ability to do that. Lots of chatter over the years. Airbnb has been around, 10 years now?
Yeah, that's right.
About how it's affected hotel markets. And in some markets, it has clearly had a tremendous effect, like New York City. And in other markets, it really has not had that much of an effect.
Right.
So it's very market-based. I would say for markets where it has had a significant effect, that effect is now baked in. The number of available Airbnb units in Manhattan fluctuates, but it's not going to increase dramatically, and it may actually end up decreasing at some point, given all the legislation and regulation that's being put forth to make sure that Airbnb plays on a level playing field vis-a-vis hotels.
Right.
That's a whole topic and discussion in and of itself. The other
OTAs,
online travel agencies. So very interesting. The online travel agencies came into the fore also 10, 11 years ago, at the very beginnings of the Great Recession, and the lodging industry somehow has a bad habit of being very reactive as opposed to proactive.
Right.
And so when the online travel agencies came around, the hotel business saw a tremendous opportunity to fill heads and beds, and did that. But they did that at a cost. And the cost, frankly, is, if you think about it, they gave up control of the most precious commodity that they have, and that is the guest, right? Guests that are booking through online travel agencies and then staying in hotels. The hotels are merely just providing the supply, if you will, but they have no control on the demand side of it. And so as the economy got better and the markets got stronger and the hotel industry realized that they were losing control again of their most precious commodity, there's been tremendous pushback, and we've seen a lot of success with hotel companies engaging in what's called direct booking programs, where they're enticing travelers to book directly with them as opposed to online travel agents. And there are frankly a whole host of reasons why guests would actually be better off booking directly with a hotel. Not only guaranteed lower rates, but the ability to cancel reservations, to rebook reservations, to be allowed access to keyless entry, other free Wi-Fi, what have you.
And also build their loyalty program, or loyalty rewards with that one particular brand.
Correct, although the online travel agencies have also come up with their own
Sure.
reward programs. So it's going to be interesting to see how that all evolves over time goes on, as time goes on. Bitcoin, which I hesitate to bring up because I'm not an expert on Bitcoin, but I have read a bit about it. And I've read that at some point there's an expectation that the transparency that Bitcoin is going to provide is going to eliminate the online travel agents. But that's probably sometime way in the future.
Okay, great. Well, one last question. We've talked about a lot of great things here, facts on the industry itself. And you and I have both been through the wars. We've seen really great things happen in the industry and on projects, but we've also seen when things go bad, how bad they can get. So maybe for a couple of minutes, we can talk about maybe a case study of a transaction that you've been maybe involved with or heard about, where when something goes bad, how bad does it get and what the ultimate outcome?
So I've definitely seen a fair share of those over the years. Two that come to mind. One is a significant resort development that was conceived in 2007. It ultimately opened up in, I believe, 2011. So obviously the Great Recession and terrible timing. Physically, an amazing property. The all-in basis on this deal was $500 million. There was a first mortgage that originally started at about $250 million. When it got up to $350 million with deferred interest and missed payments, an entity came in and bought the note for about $100 million, a $350 million note. They stuck about another $80-90 million into it. So their all-in basis was $190 million for an asset that cost $500 million to develop. So that's a classic illustration of it working for the second party, if you will. I can think of another one where I mentioned in Manhattan, a hotel that opened up right before 9/11. It wasn't worth $1 million a key when it opened up. Back in 2001, $1 million a key for hotel development was a lot of money. It's still a lot of money today. But the notion of a hotel being worth $1 million a key in the United States in 2001 was sort of unheard of. That deal, and frankly, the first deal I talked about, there may have very well been a little bit of ego that got caught up in the deal, and that's an issue vis-a-vis high-end hotel investments. Not a whole lot of ego in office and shopping centers and apartment buildings.
Right.
Hotels do tend to attract ego capital, and let's face it, like any other investment, doesn't matter whether it's stocks, bonds, real estate, right? What's your basis in the deal?
I agree with that 100%.
And, you know, a lot of folks have sort of lost focus when it comes to hotels on what their basis in a deal is. And I can't begin to tell you how many times, first question I ask somebody who I meet who's interested in getting involved in a hotel, who never did one before, is, what is your objective? And it's amazing. You don't always hear the number one thing being make money. Many times you hear, well, I want to own that place because I want to hang out there with my friends and family and what have you. Well, do you want to make? Yeah, I want to make money too. So it's kind of an interesting concept.
Yeah. Well, as you know, at Mosaic, we do a lot of hotel investments. I think we're being very, very selective in the hotel opportunities that we look at and deploy capital to. You're 100% right. Our whole thesis is, what's our basis if we had to step in and eventually own a hotel property? So I think our mindset is alike. I really want to thank you for your time. We've been friends for a long time.
Yes,
we've been through the wars together.
Absolutely.
We look to do more things together. And again, I appreciate the insights, and we'll look forward to chatting again soon.
All right.
Thank you
so much.
Thank you.